online GPS STEM career and professional development programming at UC Irvine. Our motto here is to give you training and awareness first about many different careers coming out of this PhD training, and also then give you training into that particular career and helping you gain that experience and then transitioning. So today's webinar is actually two-part. It's going to serve two parts. One is it's going to expose you to the technology commercialization space. And the second part of that, Michael will actually talk about some of the internship opportunities he might have coming up, and where you fit in, and you could use that experience and maybe a little bit of training there. So with that, I know some of you attended Chris Lay's talk last week, where he talked about his career journey from PhD postdoc in neuroscience to venture capitalism. Although he didn't touch upon many different technical aspects, because I think that was a good start. And we realized the need that we need to give more technical content. So therefore, we bring in Michael Faught for this thing. So a little bit about Michael. I actually met Michael through introduction by someone from Applied Innovation, or was someone from business school. I don't remember, Michael, because we had so many email exchanges going on. But I was told that Michael Faught, he worked with he's a current founder and managing partner for Technology Capital Partners. And Michael grew up in Italy, speaking fluent Italian. Is that right, Michael? Are you super fluent?
Well, I spoke only Italian while I was growing up, yeah.
Cool. Until he came back to US at the age of 10. And upon your return, you grew up and were educated on the East Coast. You went to Harvard for your undergrad in economics, and you were at Wharton School of Business for your MBA in finance. You know what? I was actually in Philadelphia for 6 years for my PhD. I went to Temple University, and I used to live in UPenn neighborhood. It was really cool. Okay, and after the business school, Michael, your career path took a totally different turn, and you went to Wall Street and industry, technology, commercialization, and the startup world. So following a sabbatical, which you took in secondary education and nonprofit management, about a year ago, you launched this Technology Capital Partners, which is a technology-driven growth acquisition private equity partnership. Today, Michael is here to talk about technology, his company, Technology Capital Partners, and how you use an unconventional approach to capitalizing on technological innovation, and to answer any questions you might have regarding, how PhD postdocs might benefit from, lessons learned. One thing I want to say, you'll see that there are a lot of similarities between what you do in your lab and how that can be commercialized, just that you need to be given that knowledge and training. And we'll hear that from Michael. As we go along, there's a bottom chat section, and there's a Q&A section where you can write your questions, and keep writing your questions, whatever you have, and I will ask as we go along if it is relevant to that particular slide or what topic is being discussed. Otherwise, after 35 minutes, we'll open it to Q&A. Feel free to ask any questions. Don't feel shy, even if you have a very if you think you have a naive or stupid question, there's no question which is stupid. I know this is a totally different world, but feel this is your safe space. You can ask anything, right? Michael, thank you very much for coming, and this is all yours now.
Thanks, Harinder. It's a pleasure to be here, and thanks to everybody for attending. It's really a pleasure to speak with you about these various topics that Harinder just laid out. And I want to give you first a sense of my intent with the presentation. I'll show you that. But then I want to back up, and before getting into the presentation, I'm going to provide some context and help you better understand how it is that we came to this strategy that we're now pursuing that I'll tell you about. So I'm going to share my screen. Harinder, tell me if I'm doing it wrong.
You got it right.
All right. Well, there's a miracle. So, so cover page, obviously, I'm here on behalf of Technology Capital Partners to describe to you what we do. But I want to spend a moment just describing the flow of this presentation, the sequence that I envisioned, which was, first of all, to provide some sort of context within which to think about this space. And I wanted to describe the overall investment landscape, where private equity, and specifically early and late stage private equity, sort of fits into this landscape, and how does a limited partnership actually work? These venture capitalists you hear, and private equity guys, they do very well, they make a lot of money, but how does the vehicle that they use enable them to do that. Then I want to talk about this alternative technology commercialization strategy, which we pursue, which is driven by our focus on acquisition. I'll talk about that. And then at the end, I want to answer questions and talk about the fact that we're working very closely with UC Irvine across the spectrum of the business school and the Beal Applied Innovation, and how we might find ways to collaborate. So before going into that, I wanted to just share a little bit of context with you. As Harinder mentioned, I came out of business school and went to Wall Street, and spent, I don't know, 8 years there or something like that before I went to industry. And then a Wharton classmate of mine invited me to join him at a technology incubator in Princeton. And it wasn't a Princeton technology incubator. It wasn't directly associated with the university. It just happened to be located in Princeton, where I lived. And I went into this environment as an investment banker. So my expertise was the capital markets and mergers and acquisitions. It wasn't this foreign world of technology commercialization that gave me something of an advantage, actually, to go into this environment and observe this process through this very naive lens. I had no preconceived notions about how it should be done because I had never been there before. And my job was to ultimately raise capital for these young companies that we had partnered in a licensing deal or a joint venture or whatnot with some strategic partners. And then after we had established some equity value for this technology and this startup, then my job was to raise dilutive capital, equity. And so I was observing this process, and to be honest, I wasn't sure if it was just us and we weren't very good at it, or if the entire world of technology commercialization could be improved in some way. But I was watching, again, from my very objective perspective, I was watching really compelling technology be dismissed by companies that either were so big that this technology opportunity wasn't going to move the needle for them. It wasn't important enough for them to be distracted from what they do, or from the smaller companies where they were in some way possibly threatened by this technological innovation, and it would, if they were to pursue it, it would necessitate that they fundamentally altered what they did and how they did it. And so for that reason, they really didn't want to rock the boat. So my point is, I was watching a lot of compelling technology be dismissed for not very compelling reasons. And I struggled with that. As an outsider in this world, I thought I must be missing something. And so I started thinking about it, and I, with friends in Boston from college, I approached Advent, Summit, and Bain Capital, and I started having conversations with them about an alternative strategy for commercializing technology. And what I described to them was, I said, show me the orphans in your previous investments or your previous buyout portfolio, and let me see if I can't find a match between one of our technological assets, which is really what they were. We call them portfolio companies, but they weren't. They were a technological asset with an engineer or a PhD attached, or in some cases, both, but they weren't companies. So I said, let me see if I can't find a match between one of my technological assets and one of your portfolio companies that maybe has been displaced for some reason. It's been surpassed, and therefore it's never going to represent an exit opportunity for you to realize on that investment. And as we were working on this, Summit and Advent weren't very interested, but Bain Capital was. And we started working on this, and I can get into more detail later, but it was that early work that I did with Bain Capital while I was in Princeton that led to this notion that under certain circumstances, you can accelerate the commercialization of technology by acquiring an existing operating business rather than trying to convince that business to license your technology. So the mentality was, let's not try to peddle or force technology into the market. Let's instead commercialize this technology ourselves by acquiring the platform company through which we will do that. So anyway, that's what we do. I wanted to give a little bit of context for where this idea came from. It's not something I cooked up on my own. It's something that really came from working with Bain Capital that you may know of. But we'll come back around to that when I'm describing in more detail. So my intent for this presentation was to first give you a sense of the investment landscape, so you know where all of this, how this fits together. So I think this covers everything. I don't know, but basically we're talking about the equity markets, the public markets. These are domestic equity and foreign equity. You have large cap, small cap, emerging growth, you know, all sorts of different variations on US and foreign international equity stock, the stock market. And then you've got the similar thing with regard to fixed income. So these are bonds, these are stocks, and these are bonds. And then you've got this thing over here called alternative assets. And the idea when you're constructing a portfolio is to put together a bunch of things that are uncorrelated. So that, for instance, in the simplest case, when stocks are going down, presumably bonds are going up because those things move in opposite directions from each other. And similarly, the alternative investment space relates to your overall portfolio in the same way. And of all these boxes down here, you see convertibles, you see hedge funds, you see real estate, you see currencies and commodities. And this little box right here is what we're going to talk about today. This is the private equity world. And it's comprised very simple. I'm going to be very simplistic today describing this universe, but it's comprised typically of early stage investors and late stage investors.
Like there's a question, I think, again, as I told them, there's no question which is naive. They want to know what's the main differences between private equity, venture capitals, and sort of the hedge funds. These are the big terms which, you know, very difficult to sometimes, you know, differentiate and understand. Would you mind talking a little bit more about it?
Well, coincidentally, that's what this chart is about. So in terms of the alternative asset space, where you have hedge funds and real estate and commodities and private equity, within private equity itself, what private equity means is that, you know, equity is an ownership stake in a company. So if you buy a bond of a company, you're lending them money in effect. If you buy equity, you are acquiring a sliver, an ownership stake. One share of stock is an ownership stake in a company. And companies that are publicly traded, you can call your stockbroker and you can, you know, buy 100 shares or sell 100 shares. It's very liquid. But in the world of private equity, it's not liquid. It's very illiquid. And the transactions are all negotiated. And typically you are negotiating not for a few shares, but for percentage points of ownership in a company. So in this is what I'm attempting to convey in this chart is that the two axes, you've got the return on the left, lower at the bottom and higher at the top. And then across the bottom, you have the level of risk. And it's lower at the left and higher at the right. And so, again, focusing exclusively on private equity, you've got late stage, what they typically call buyout firms on the lower left, which typically has a lower return profile and a lower risk profile than early stage investors. If you're an early stage investor, you're, you know, in a lot of cases, you're investing in someone with a plan and maybe a technology and maybe expertise in a certain field or not. So that's a very risky thing to do when you're investing in venture capital, early stage companies. When you, on the other hand, are investing in buyouts, there the idea is that you're going to acquire existing businesses. Maybe they're doing 10 million in revenue, maybe they're doing 50 million, maybe they're doing $1 billion, right? And the idea is you're going to acquire an existing business and you're going to make it more profitable, okay? With venture capital, you're going to acquire a concept or an early stage business, and you're going to grow it into a real business that can be sustainable and become profitable, as opposed to buyouts where you're buying existing businesses and your intent is to make them more profitable so that you can sell them for more than you bought them for. So Harinder, I hope that sufficed, but let me move on here.
Yeah, no, please go ahead.
So very, very simplistically, again, there's a lot of words here. I'm going to try to keep it super simple. I wanted you to understand how a limited partnership works. And again, there are lots of flavors and lots of variants, but in a very simplistic description of this, on the one side of the table, you've got the general partners. By the way, Harinder, can you see my arrow when I do that?
Yes, I do.
Oh, good. Okay.
Really good.
So here's your general partners, and over here, here's your limited partners. And essentially, the deal is the general partners will do all the work, and the limited partners will pull up all the money. And then they'll split it in some way when when the time comes. And typically a partnership might last 7 or 8 years, or, it varies. But so the idea is that within a general partner, you've got industry experts, maybe finance people, maybe consultants, maybe executives from an industry or whatnot. And on the other side, the limited partners who put up all the money are pension funds and endowments and foundations and family offices. So they represent pools of capital. And on the other side, you've got general partners who have a specific strategy that they want to pursue. And they have convinced these limited partners that their strategy will enable them to perform better and generate higher returns than the more liquid public markets. So that's the idea, all right? And as I said before, private equity presumably will move in a contrary way or an uncorrelated way to the public markets because it's private. Now, that doesn't always happen. Sometimes the private markets move in the same downward direction or upward direction as the public markets, but the intent is to, as a portfolio manager, you want to assemble a pile of assets that are not directly related to each other and not correlated, I should say. So generally, in a very simplistic way, let's just say that this general partnership raises $100 million. So there's their $100 million. They do all their work, all these experts over here, they make their investments, they find their deals. And at some point in the future, it's worth $200 million when it's time to liquidate the partnership. So what happens is, first of all, the limited partners get all their money back. Okay, so they invested 100 million, let's say, and they are going to take their 100 million out. So there's their 100 million they get first before the general partner gets anything. And then the limited partners get a preferred return above and beyond their money that they put in. And I just chose 8% because that's typically the case. After that, there's a phase where the general partner does a catch up on this $8 million. And in this case, let's say they're taking their $2 million in a catch up. And then ultimately the deal is that what's left will be split 80-20. 80% goes to the limited partners who put up all the money, and 20% goes to the general partners who did all the work. So again, I don't want to get bogged down in the details, but this is what you hear. You typically hear your 2 and 20. The 20 is the equity participation and what they call their promote or their carried interest. And the 2%, in this case, 2% of 100 million is the money that they use to cover their expenses while they're looking for deals. And they pay themselves a salary and their staff, and they pay for airplanes and hotels to go look at companies when they're evaluating them. Not that they're buying airplanes, don't get me wrong. They're covering their expenses, okay? So that's how a partnership works. And again, when we get to the Q&A, I'm happy to go into any of this in more detail. But so first of all, we're talking about where does private equity fit into the universe of investments? And then what does early stage look like compared to late stage? And is one riskier than the other? And then lastly, how does a limited partnership work, which I've just described? So now, what is it that we're doing that is so unconventional? And I touched on it earlier, but the mentality here is that we view technology itself, under certain circumstances, we view technology itself as a form of capital. So it can be invested, in our case, in the pursuit of acquisitions. And so what we're talking about here is that technology can be invested in the pursuit of acquiring a lower middle market operating company. And by lower middle market, that just means a smaller company. It's not a $1 billion company. It's doing revenues, let's say, between 20 million in revenue and maybe 150 million in revenue. That still seems like a pretty big company, but it's small relative to how really big companies are. And the notion is that we're going to invest the technology in this company that we acquire, and we're going to take their existing commodity product. And when I say commodity product, what I mean by that is that it's just, they do the same thing everybody else does in the same way. They don't have any particular advantage relative to their peers with regard to their product or service. So our mentality is, let's acquire this undifferentiated operating company where we have first located technology that can represent an unfair advantage for that company that we acquire, and thereby create really attractive investment opportunities for the limited partners that we work with and our funders. So the idea is, let's turbocharge an existing product or service and enable that company to take market share from its competitors and to dramatically increase its profitability, rather than being what's the typical case that I was observing from this technology incubator. We were trying to get those guys to license our technology. And I just felt to me like we were always negotiating from a position of weakness, as opposed to, so that's where this notion was, as opposed to trying to get them to license it, why don't we acquire them instead? And we will control our future, and we will capitalize on the technological innovation, because we are going to own the company through which we're going to do that. Okay. Again, I'm happy to go back and review. I have a lot of things to cover, I think. But so this is an attempt to sort of, show what we're talking about. And it's really pretty simple. We're talking about disruptive technology it's fully baked. We are not interested in technology that's in development. And we maintain that there's a vast amount of technology that's fully ready to be deployed. There's no more research and development that needs to do. And it's a vast amount relative to a gargantuan amount of technology that's in development, right? So it's only a small part of the universe of technology, but we believe there's a lot of it that fits this profile of technology that's ready. It's completely compelling and immediately deployable. It's commercially significant, and it can alter the competitive dynamics in an industry. And then the question is, well, that's so cool. What do we buy with it? So this is where we do our research, and we evaluate what company can the investment of this technology most unfairly advantage. And the objective here, obviously, as you see on the right, is to create a market-leading growth company from one that previously maybe wasn't growing at all, or very slowly, or maybe it was even in decline. And we refer to this strategy of acquiring operating companies, having first located technologies that will disrupt their industry. We refer to them as technology-driven growth acquisitions. And what I'm describing is something that is unconventional, right? This is sort of a hybrid between what I described earlier of a buyout model and a venture model, because typically the technologies we're dealing with would seek to attract venture capital in order to build a company from scratch. As opposed, and on the other end, the operating business might seek to be acquired because they need additional capital in order to make themselves more profitable and more efficient. And what we're doing is a sort of a hybrid between the two. We're locating technology that's ready to acquire and unfairly advantage operating businesses.
So, Mike, there's one question in terms of disruptive technology. The person says, is disruptive technology something which is out of the box, more like, which brings about a paradigm shift in the way we understand a particular technology field, or any startup or new technology is called disruptive technology?
Yeah, it's interesting, because when I did this originally, my original thought was, let's go look for technology that is not gaining momentum, and it's not successfully raising venture capital. It's not the sexy, shiny technology that the venture capitalists are pursuing these days, looking for the next unicorn. It's not going to be $1 billion exit necessarily. So the original thought was, this will probably more likely be effective in a more industrial and manufacturing tech, robotics, materials, sort of, I won't call it low tech, but it's not the sexy stuff that everyone's chasing today, like artificial intelligence and big data and Internet of Things. That's attracting a lot of attention from the venture capitalists. Our strategy was to pursue things that were languishing because they weren't successfully attracting the attention of venture capital, right? Did that answer your question, Harinder?
Yeah.
Okay. So what's actually turned out to be surprising to us is that what we do lends itself to technologies beyond those sort of industrial and manufacturing technologies. So right now we're working on a deal in nanotech. We're looking at a deal in medical devices materials, and another one in big data that relates to water metering. So to my surprise, we don't have to be, in this lower tech arenas, although I like those because I can understand them, right? But this lends itself to, I've seen biotech deals, I've seen renewable energy deals. There's a lot of opportunity here. So, but the absolute essential piece of this, and that's why on the front page, I refer to us as investors of technology, not investors in technology. And what I meant by that is that we look for technology that's fully baked, and we seek to invest that in an acquisition of a company, right? So we don't invest in developmental technology. If you need 6 months and $200,000, that's, you know, that's not what we do. But on the other hand, if you have technology or know people who have technology that's fully baked and they're struggling to commercialize it through the traditional methods, that's of great interest to us. That it's ready, that it's struggling, and that it applies to a big market where there are lots of acquisition targets. Okay.
So Mike, yeah,
Um,
Michael,
so
there's a question from one of the students, Melissa. Melissa asks, can we revisit for a moment the role of PhD or postdoc within the process? I wonder if you're going to bring it up later on, but I think the specific thing is, would a PhD postdoc be looking at promise of technology?
Sure. Well, we're going to get that at the end, but let me address it now. So I know there's a lot of PhDs and postdocs on the phone, and you may be wondering, you know, how this applies to you. And first of all, it's hard to aspire to something if you don't know that it exists, right? So my first objective is to make you aware of this world of private equity, what it looks like, where it fits into the investment world, and to tell you that your expertise as PhDs in a given area of expertise is extremely valuable to companies that, you know, private equity firms and venture capitalists who invest in your area of expertise. So we're launching we would have done it by now if we weren't like hung up by this virus that's keeping everybody at home. But we've had an internship program with USC for the past year that we are going to replicate at UCI. And among our interns, we have a PhD candidate who is getting her PhD in cancer research and genomics. And so here's someone with a highly technical background. I think she's a year away from getting her PhD, but she has a particular interest in business and investing, and how can she capitalize on her expertise and her degree and, you know, be well paid for it, and not necessarily go into research or, you know, become a doctor or whatever, but she'll get her PhD, so she will have her doctorate. But the question is, we are looking for people who have expertise in technology that can be applied to our model, who can participate in our deals, or we're looking for folks who have backgrounds in finance and M&A and private equity who have an interest in technology and also can participate in our deals. So the reason I'm here talking to PhDs is to make you aware of the fact that your area of expertise has great value beyond research, right? And in our case, it could participate in one of two ways. You could help us locate the technology, qualify it, strategically position it, and help us, you know, establish that it works and that it's compelling and that it has an advantage over other technologies, and then help us determine, what do we go acquire with it? What company's product or service could we most immediately and most dramatically benefit by infusing this technological innovation? So for instance, one of the deals we're working on right now is in the field of boron nitride nanotubes. And it specifically, we're looking at it in the context of industrial water filtration. Boron nitride nanotubes has all sorts of relevance with regard to NASA and all sorts of applications. And we're looking at it specifically to pursue opportunities in water filtration. Harinder, did that answer the question?
Yeah. Melissa, if you have any more follow-up questions, feel free to write in here. Michael, do we have question for one more question related to this slide? I think it's very relevant.
Yeah, it's only 12:30, so I was planning on speaking for 10 minutes and then answering questions for 20.
Oh, cool. No, I think you have a lot of...
speaking for 40 and then answering questions for 20.
Yeah, no, there are very good questions coming up. Winston asks, does TCP first find a disruptive technology and then match with a platform company in a commodity industry, or does it happen the other way around? Yeah, that's a really good question.
That's a very good question. And typically in the world of M&A, which is M&A stands for mergers and acquisitions, it's not uncommon to acquire a company, and somewhere on your growth plan for that company, here's all the things we're going to do that's going to make it more profitable or more efficient or whatever. And somewhere down your list on your plan is you're going to go find technology that's going to enable you to have this unfair advantage relative to your competitors. Well, the problem is that the universe of technological innovation is so vast that's very difficult to do. To start with the operating company and then to try to go find, Bain Capital called it the silver bullet. I refer to it as the needle in the haystack, right? So to acquire an operating business and then try to go find the technology that's going to advantage it, I think is a very difficult thing to do, right? I think it's it's not easy, don't get me wrong, but it's relatively easier to find that needle in the haystack first, that technology that fits your profile, which is it's immediately deployable, it's disruptive, it's struggling to find its way into the market for some reason. Maybe the venture capitalist concludes it's only a $300 million opportunity and they're only looking for unicorns, right? So I still think it's very attractive technology that can drive very profitable acquisitions. But so we start to answer the question, let's locate the silver bullet first. Let's locate that technology, that needle in the haystack. And then given information about companies, it's relatively easier to determine what industry does that technology belong in and what companies are within that industry space that we might acquire. Good? Okay, I'll move on.
Yeah.
I think I'll move on. It's not actually, oh, there we go. Okay, so here's what I'm trying to convey. As you'll remember, this should look like that earlier chart. So here's the early stage venture capitalist up here, high risk, high return. Here's the buyout guys, low risk, low return. And remember, I'm speaking relative here. So down here are the public markets. So historically, over long time periods, the public stock market has typically returned about 10%, call it 9%, 10%, something like that. So you would expect, if you're going to take the additional risk that's associated with an illiquid investment, that you're going to get a higher return. That's a more risky thing to do. And I'm sorry. So you would expect a higher return than the public markets that are liquid, right? And so when I say lower return, I mean lower than venture capital expectations, okay? But our model, we believe that what we're doing by acquiring operating businesses into which we invest technology, we believe that we're leaving this continuum that I showed you earlier, and we're moving up and to the left. And that's a very good thing, because what it says is we're reducing the risk profile of our deals while we are raising the expected return. So the way we think about this is that we expect to capture the lion's share of the venture upside while eliminating the lion's share of the venture risk by acquiring an existing company rather than raising venture capital to build one from scratch. So this is our strategy right here. We believe we're doing lower risk deals at a higher expected rate of return. And that's obviously a good thing. So here are some of our advantages. We maintain that this approach creates proprietary deal flow. And what I mean by that is this world of investment bankers that are out there, particularly mergers and acquisitions bankers, they exist to make sure that every company that becomes for sale gets auctioned off to the highest bidder. And so it goes for a premium price. If you want to buy this company and you're competing with other private equity groups, or you're competing with strategic acquirers like big companies, this company is going to be sold for the highest price. That's what M&A bankers do. It's sort of like a real estate agent, not to be derogatory towards either side, but that's what they do. M&A bankers are there to sell companies to the highest bidder. And we believe that by putting deals together the way we do, we are acquiring these undifferentiated operating businesses for whom there aren't a lot of bidders. In fact, there may be none, because these companies are growing very slowly, if at all, or they might even be in decline because they're a Me Too competitor, right? And again, maybe they're a $40 million company or a $70 million company, but this is very, very important, that we are not competing against a bunch of other investors and acquirers for the companies that we seek. And we're interested in acquiring those companies because we first located a silver bullet that will enable them to grow very rapidly, okay? Alignment just refers to the fact that these venture capital funds that we partner with to finance our deals, they put up the money in order to pay for these acquisitions. Their funds are getting larger and larger all the time. And it's becoming increasingly difficult for these funds to put out relatively small amounts of capital. So we talk about the fact that it's easier today to raise 50 million than it is to raise 5. And raising 50 million aligns nicely with the fact that we're acquiring operating companies rather than making relatively small venture investments. I talked about the risk-reward disconnect, where we think we're going to generate risk, venture-like returns at buyout-like risks. We talk about the fact that management, when we're going to acquire an operating business, there's a management team already there. They have customers, they have contracts, they have revenues, they have, we can evaluate a going concern much more effectively than we can evaluate what you tell us you're going to go build once we give you $3 million, right? So we think that's a much lower risk proposition, which will enable us to retain or attract better management to our deals. I talked about, that we think there's a lot of technology that fits our profile. And ultimately, we think that we're putting together deals where 2 and 2 equals 7, at least, maybe more. I talked about this already. Here's what's important to us. The technology is immediately deployable. It's underutilized or languishing. It might be, as is the case with this boron nitride nanotube, that they're pursuing opportunities with NASA and in the context of space travel, but they're not doing anything in the context of water. So it's underutilized in the sense that there's this whole big market that they're not pursuing. The acquisition landscape has to be attractive for us with lots of targets. The technology needs to be disruptive. It would be great if it was patented or had some other barriers to entry. It's a simple ownership, and we've got owners who have struggled. They've done everything they were told to do. They tried to license it, they tried to raise venture capital, they tried to sell it, and for whatever reason, they were unsuccessful. Not because the technology isn't ready or compelling or any of those things. It's because it's not a big enough opportunity to attract, to suggest that it's the next unicorn coming out 5 or 6 years from now. So this is the end, and this is where I really talk about, where do PhDs fit into this? And that's what I described earlier. Your expertise with regard to your field of study and your doctorate is extremely valuable in the context of people that are trying to figure out what they do. So how do they know, if they're a venture capitalist, how do they know that this technology is the cutting edge stuff that they should invest in? They don't, typically. A lot of venture capital firms hire PhDs to be on their staff, and maybe they'll focus on a specific area of technology. Maybe they only do renewable energy, or they only do, manufacturing, or whatever it might be. So you have to align your PhD with their area of focus. I mentioned earlier that we're interested in working with you as interns, specifically working with technologies that are coming out of UCI. And by the way, my son graduated from UCI, so I'm a little bit familiar with it. But what's there now, that research park that has been built, and what Beal is doing, and it's just remarkable, right? So I believe that there's a vast amount of technology that either still resides within UCI or came from it that fits our profile. It's compelling, it's ready, and it's struggling to find its way into the market. I think there's a lot of that stuff, right? And then as far as you as a PhD, this is your opportunity to make yourself indispensable. Because of let's say, Stephanie, who is a PhD candidate in cancer research and genomics. She's invaluable to us, certainly, as we evaluate technologies, but she will be invaluable to a buyout firm or a big corporation who's focusing in cancer research or whatever it might be. So I would urge you to think of your PhD as sort of a stamp on your forehead, a seal of approval that you're committed to this area, and you can in effect monetize it by taking your expertise to people who need it. So I'll stop there. I know I covered a lot of things very fast. I want to. It's now, what time is it? It's 12:40. Good, I'm on schedule. So I planned on talking for 40 minutes and answering questions for 20. I'm happy to answer questions either directly or even indirectly related to what I talked about. I'm happy to back up through the deck if you like. So Harinder, what questions does your group have?
Thank you, Michael. This was very helpful. And I just want to say one more thing, that Michael Faught is on LinkedIn. When I shared advertisement with all of you, I did put in a hyperlink to his LinkedIn profile. If not, go on LinkedIn, look him up on that, and send him a short message. Is that the best way to contact you, Michael?
Yes. Yeah. If you're going to contact me, give me some sense. I get a lot of people just wanting to connect with, and I have no idea why. So if you want to connect on LinkedIn, or you just want to discuss something, please let me know specifically what you have in mind.
Yeah. Michael, now we have a few more questions coming up. Another one is from Melissa again. Thanks, Melissa. Melissa says she's a little bit confused about acquisitions. Would you mind elaborating on that? And does TCP acquire the technology or the company or both?
So, okay, so first of all, acquisitions means that, the mergers and acquisitions universe is, let's say you built a company or your family built a company years ago. It's been in business for 30 years or whatever, and they make widgets. And your parents are, they're co-founders. They've been running this business for years. They're aging, and you guys aren't interested in getting involved in their business. They will typically approach an investment banker or a business broker, and they'll want to monetize that company. They'll want to sell it, right? So if it's a sufficiently attractive business that in some way relates to artificial intelligence or Internet of Things or whatever, some venture capitalist, some private equity firm may acquire it. And so mergers and acquisitions just means that in a merger, you're putting two companies together because you think that the whole is worth more than the sum of the parts. And in an acquisition, you're just you might choose to acquire a company. So when you invest in the stock market, you're acquiring a little piece of that company. But if you're very wealthy and it's possible for you to finance an acquisition either with your money or somebody else's, you might decide you like this company so much you want to buy the whole thing. So that's what mergers and acquisitions are. And within investment banking, you have people that raise capital, and then you have people that specialize in mergers and acquisitions. And again, the simplest way to think about M&A is sort of like being a real estate agent. Your job in real estate is to sell a house or some other property for the highest possible bid. Oh, and the second question I'm sorry, Render, I forgot the other question.
It was about, do you suggest looking at firms or companies, or if you wanted to get into space? Okay, no, that was
I remember.
The second. Yeah, second part was does TCP acquire technology or the company or both?
Yeah, so good question also. And it relates to that other question that I asked earlier, how we operate. So again, from my experience as an investment banker in the world of technology commercialization, we had a portfolio in Princeton of these, 30, we call them portfolio companies, but as I mentioned earlier, they weren't. They were technological assets that had an individual or two around them. And they were very compelling technology, but they weren't companies, right? So what I concluded and what I've done successfully, maybe I should mention that I've done this before, but what I've done successfully was I concluded that the last thing I wanted to do was end up with a portfolio of technology that then I would have to be responsible for, like we were in Princeton, right? So our strategy here is to enter into an agreement with the owner of the technology that says, look, we buy what you're selling. We're convinced by your technology. We think it's compelling. We think it's ready. We think it has great potential. And we will enter into an agreement that we will do all of our research to identify acquisition targets, to negotiate the deal, to raise the capital, to close everything. We'll do all that work if you just commit to deliver the technology into the deal. In the meantime, you go ahead and try to raise venture capital or do whatever you want to do to continue to advance the interest of your technology. But if when we acquire a $100 million business based on the potential of your technology to unfairly advantage it, we need to ensure ourselves and the company that we're going to acquire that the technology will be delivered. So to answer the question, we are not acquiring a portfolio of technology. What we're doing is we're entering into an agreement with technology that they will invest their technology in our acquisition that we do all the work for. So I hope that answered the question.
Yeah, we actually have a lot of questions coming up. There are 3 questions total, but first 2 are actually related. So Catherine asked the first one and Andrew asked the second one. I think they are related, they are part of each other. Catherine asked, how can we get involved with TCP internship program? And Andrew asked a very good question to actually get into the internship. He says, a potential concern from my PhD advisors, who are the ones who lead the lab, maybe how participating in this internship will benefit my lab, their lab. How would you frame this as a win-win for both the parties?
Yeah.
So, really good questions.
Yeah, both of them. And repeat the first one for me. I'm already thinking about the second one.
Yeah, the first one is, I guess you could go in any order. First, like, how do you get involved in the internship
Okay,
program?
okay,
And to
okay,
say is like, how can
right.
this be a win-win?
Okay, so what we did at USC, we have an internship program. We started at the business school. From there, we were brought into what's called the Alfred Mann Institute and the School of Engineering, Viterbi School of Engineering. From there, we accessed USC Keck. And so once the word got out at USC that we are looking to involve PhDs and engineers and graduate students in general in what we're doing, we were overwhelmed by various parts of USC approaching us. So right now, and Harinder has our internship description. He can post it someplace, but I started by approaching Beal Applied Innovation. I was referred to them by the head of economic development for the city of Long Beach. And from that work with Beal, we then, it was actually Beal who suggested we replicate this internship program that we already had at USC. They said, why don't you come do it here and focus on UCI technologies? And I thought, yes, I thought it was brilliant. And why didn't I think of that? I just didn't have time. But so now we're talking with Beal, we're talking with Harinder's PhD and postdoc program. We're talking with Chris Kovitz, I think his name is, at the
Yes.
business school. So that program, and right now I'd be telling you all of this in person if we weren't locked up. But yes, if you're interested, I'd love to hear from you. And so that's that. The second question was a concern on the part of your advisors that how is this going to benefit you? I think that's pretty obvious that it's going to benefit you by the fact that it's broadening your field of vision, and that you as an engineer, as a PhD, have an expertise in a field that's of great relevance to the investment landscape, whether it's in public companies where you can go work as a PhD at some big company, some billion-dollar public company, or you might go work with a venture capital group, or you might work with a private equity group who, like us, who, in our case, we pursue something that I believe is genuinely unique. So I don't think you'll hear anybody else talking about, technology-driven growth acquisitions the way that we do. But to convince your advisor that this experience on your resume of working with a private equity group who's pursuing acquisitions of operating companies, it's going to add a huge chunk, not of credibility, you already have the credibility, but in terms of your understanding of the breadth of the opportunity that your PhD, opens up for you.
Yeah, another thing I would like to add, you really have to, now these are, again, as I always say, COVID-19 are very challenging times, and you will see that there are going to be drastic funding cuts in academic research. So it is a win-win for both the parties, which you can explain the way you would like to use your best way to tell them that you need to build partnership with the industry, because industry is really on the forefront of technology, and we do basic research. What about if both the industries join hands, and then your research accelerates faster, because now you probably don't have to worry about the money which is going to go down from NIH for next 6 months to a year. So that's another way to do it. But I like the way you said it, Michael. I have another couple of questions. So Hamza had a question before that. Hamza says, as a PhD, what types of job titles or roles would you suggest looking at firms or companies for if we wanted to get into the space?
Well, this space, I assume, we're talking about private equity, whether it's early or late stage. And I think as a PhD, it's interesting. When I came out of business school, I went to Lehman Brothers, and Lehman Brothers was known for a highly aggressive. Everyone has done an all-nighter, but I doubt that very many people have done 2 all-nighters in a row the way I did when I was working at Lehman Brothers. I came in on a Wednesday and left on Friday evening, and never slept. So don't get me wrong. If you're going to go to Wall Street or going to think about getting into the investment universe, you are going to work very, very hard. But the difference is that you come into that environment with a unique field of expertise that adds great value to what that firm does. So, Harinder, I'm not sure I answered the question, but
yeah, I think I agree with you. There are like some specific job titles, but do you think the job titles sort of like evolve as based on the job description? Should people be looking for a job via job titles, or they should actually read the job description and then, title could be anything. Is that right? That's
Yeah, the title could be anything. It could be that you're an outside consultant that's retained by a private equity group on a case-by-case basis because the technology relates to your PhD, right? Or you could be hired full-time as, going in with your PhD. You could probably, if you went to Morgan Stanley, I don't know, maybe you're going in as an associate or a senior associate or something. But it almost doesn't matter in terms of a title. What matters is how you're being paid, how you're being compensated for the work that you do and the value that you bring. So, it's unlikely that you would be hired into a big investment bank at a high title because you have to prove yourself. Show us what you can do first. And the way I learned it at Lehman Brothers was you get the title when you're performing at that level, right? You don't get the title first and then they expect you to perform at that level. It's like you show us that you are a vice president by what you do and how you perform, and then you'll get the title and the compensation. So the title is, comes with time, I suppose, but it won't come with time if you're not valuable to that company.
Great. We have next question by Michelle Reed. Thanks, Michelle. She has a question for non-PhD students on call. Advice for transition from a non-finance role into private equity and venture capital space.
Well, again, I think what is the field of expertise that we're talking about? Is this a engineering undergrad? It's really a question of what you can bring from your education to add value to what an investment firm or an investment bank or a corporation already does. So it really depends. If you're a cancer researcher with a PhD, I wouldn't necessarily be approaching a private equity firm that specializes in industrial manufacturing acquisitions, that kind of thing. So you've got to align. The question you ask yourself is, where does this investment that I've made in my education add the greatest value, and to whom? And you'll find that in the private equity and then in the venture capital world, there are PhDs all over the place, right? So they're already there. So you may have to elbow your way in and demonstrate your ability to add value to a firm that already recognizes the value of PhDs and engineers or technical undergrads.
I think Michelle has perfect credentials. She says she's an MBA student and she has business undergrad, and right now she works in AI and ML space. Perfect, right?
That's the great balance. That's what I was saying.
Yeah.
We're looking for technical people who have skills in finance or want them, and we're looking for finance people who have have a broad and deep interest in technology and how we put those two things together. So yeah, that background sounds excellent.
Yeah, Cameron has a question. Thanks, Cameron. He says, you don't acquire technology, you just come to an agreement. How often does it happen that before you find a company that can use technology, the technology gets bought out by another company?
Yeah, it doesn't. That's the point I'm trying to make, is that in this world of technology, let's say that's 100%. And you've got the venture capitalists largely investing in the top couple of percentage points of that. And let's say, so we're down to 97% of everything, right? Of that other 97, probably 90% is developmental and in research and not ready. And of that other, I think 7%, if I did my math right, a lot of that stuff is just, if it were going to be of interest to venture capitalists, they'd already be there. So there's a vast amount of technology. That 7% is still a huge amount of technology that fits this profile of being fully ready. And remember what I was observing with this technology incubator that was populated by licensing attorneys, intellectual property attorneys, consultants, PhDs. These were all very smart people, and yet we were not getting this technology get commercialized, which is what led me to try to find another way, right? So my point is that we play in this realm of technology where it's immediately deployable, it's disruptive, but for some reason, it's not attracting capital, it's not attracting acquisition interest, but it's not because the technology isn't compelling. There's a lot of compelling technology that never sees the light of day. And so that's the technology that we're looking to partner with. But the way we're going to commercialize it is, instead of trying to convince somebody to license it, we're going to acquire an existing business that we conclude can be unfairly advantaged by what this technology can do for their product. You know, Harinder, would it be helpful if I described that tank inspection deal?
Yeah, yeah. I was actually going to ask you if you could give a specific example. That would be very useful, please.
Yeah. So when I did this the first time, and by the way, the demonstration of this approach, I'll just give you the highlights. But it was in software and digital switching. We invested $12 million in equity out of a $30 million financing, so 18 million in debt, 12 million in equity, and 5 years later we sold it for $85 million. And that was sort of our proof of concept. But to really help you understand what I'm getting at, and I'm going to use a less sexy technology example, but it relates to the industry. You know, these refineries that are all over the place, they have these enormous tanks that hold millions of gallons of petroleum or whatever it might be. Well, the EPA would really like it if those tanks were inspected periodically, and they would like it if they were inspected annually. But the way the industry operates that conducts those inspections, are you still there? Harinder, are you still there? The screen just went blank on me.
Yes, I am. I was trying to play with it. I'm sorry.
Oh, no problem. Shall I bring it back up again?
Yeah, if you could maybe stop sharing your screen. I was just trying to do that. Stop share. Did that work? Let's see.
Okay.
Yeah. Okay.
Okay.
No, this is great.
Okay, so what I was describing was an industry that inspects these ginormous tanks that hold millions of gallons of petroleum. And the way the industry operates, which is comprised of hundreds of little Me Too companies, they all inspect the tanks the same way. And the way they do it is that they require that these tanks be empty. And then once the tank is empty, they enter that space and they'll take a week or two and conduct their structural integrity testing. And at the end, they provide their results and they charge $20,000 for what they do. But the problem is that having this empty tank for a month or two adds about $80,000 to the cost of each inspection. So as a result, it's costing them $20,000 they're paying for the service and $80,000 from having an idle tank. So guess what? They don't get inspected very often, right? So I learned about that after I had first met a gentleman in Houston who had built a submersible robotic wall crawler, a robot that had all the ultrasonics and all the GPS technology built into it. And he had demonstrated this technology by inspecting a tank, one of these huge tanks at a mobile oil refinery full of diesel fuel. And he conducted that inspection in 3 days without draining the tank, right? So here's the typical PhD who was trying to commercialize this technology. He had tried to license it. He had tried to sell it. He had tried to raise venture capital. And, you know, frankly, just nobody cared, right? So, but it worked and it was ready and it was immediately deployable. So when we met, I said to him, why don't we instead begin acquiring these tank inspection companies? And each one that we acquire, we will empower with this unfair advantage, which is your robot, which will enable that company to take business from all its competitors. Because why is anyone going to hire anybody else? If I can inspect your tank without draining it and everybody else has to drain it, why would you hire anybody else, first of all? So I'm going to take business from all my peers. And secondly, I'm going to double my price. So my $20,000 inspection is now $40,000, but I'm saving you 60 and the logistical nightmare of having to manage the logistics of emptying and filling up these tanks. So I hope that helps you understand. The idea here is by infusing technological innovation in an otherwise Me Too company and giving them an unfair advantage in order to grow rapidly and be very profitable.
Great. Cameron has a second part to his question. Also, when do you find a company that can use technology? At that point, do you acquire both company and the technology?
Well, what we do is, like I said earlier, we don't have an interest in acquiring technology for its own sake, right? It's not like, oh, we'll acquire your technology and then we'll go find an acquisition. We enter into a handshake, which says, look, we're going to pursue an acquisition. And when we've got that ready, you're going to invest your technology for stock in that, or maybe you'll license it. There's any number of ways to do it. And so, let's say your technology is worth, you raised money at $4 million before pre-money. You're going to invest that technology at $4 million. You're going to get $4 million worth of stock in this private company, and maybe some of it will be cash instead of stock, because you could probably use the cash. And then ultimately, though, your technology's ability to rapidly grow this company very profitably, and when we sell it, that's when your $4 million will become worth 20 million, right? That's the objective. We're not interested in taking your 4 million and making it worth 5, right? This is disruptive and profitable growth. It's not incremental benefit.
We have a question from Kristen Gabriel. Thank you, Kristen. She's got two questions. First, you mentioned that technical background example, cancer biology, but do you also look for PhDs who have some sort of financial background, example, courses in finance or MBA? And the second part is, what are the critical factors for a success for PhDs on this job? Really good question.
So absolutely. If you come in the door with a PhD and coursework in finance, and you understand a lot of what I've just been, sharing with you, that's great. You've got a running start. There's a lot of things you're going to need to learn unless you've already done financial modeling and you have that already in your toolbox. That's wonderful. If not, you're going to need to learn it. So yes, if you come into the picture and approach us with a PhD and an MBA, or an undergrad in finance and engineering, masters in whatever, that's very appealing to us that you have both sides, right? That's what we're looking for. Second part of that question?
What are the critical factors for success of for PhDs on this job? I think answering maybe first, but I have a question. Do you think if they were to do, because not everyone can actually get into MBA and pay hefty amount of money and try to get that degree, or doing courses in finance, do you think short internship would be sort of equivalent to what you could, gain by getting educational training and still be eligible for these kind of jobs? What do you think?
Absolutely. That's the thing is, which piece do you bring? Do you bring the finance background and you're willing to invest yourself in learning about technology? Or do you bring the technology piece and you're willing to invest yourself to become proficient in on the finance side of what we do? So we're looking, ideally, we hire people that have both of those things. We have one of my colleagues he was a 30-year attorney. He was a partner with a law firm and then a managing director with an investment bank. And he has a particular expertise in medical devices and oil and gas. So needless to say, when we see technology related to those two areas, we put him on that deal. So yeah, absolutely. If you've got both already, that's invaluable, just because it accelerates your ability to, add value to what we're doing or what anybody else is doing in this investment landscape.
Mm-hmm. Great. Melissa has another question. I think this is very relevant to what PhDs and postdocs do in lab, and thinking about how that can be translated. So she's asking, what would a day in life of someone validating technology be like? Thing like literature search, reading papers, data mining, meetings, and travel, etc. Could you enlighten that on that?
Yeah, well, let's just use UCI as an example. Let's say there was a UCI PhD or postdoc who was interested in what we were doing. And the way I look at somebody like that is that there are man or woman sort of in the tent, right? They are at UCI, and they will, as I'm doing right now with one of our interns from USC, we've got all these relationships with USC. The first project I put her on was, are we in all the right places? Where are we not yet? Where do we have to reach out and establish relationships so we're sourcing technology beyond what we're already doing? And we're already doing a lot. So let's say we've got a PhD at UCI or a postdoc who the first thing they would do is, I've got a general sense of these repositories of technology within UCI, but they would be our boots on the ground, so to speak, and they would assist in locating technology that fits our profile. And 95% of what's out there doesn't fit our profile. It's too early. It's developmental. It's whatever. It's being invested in by venture capitalists. What we're looking for is that technology. The sort of the redheaded stepchild. It's fully ready. It's in the hands of somebody who has tried everything and they're struggling. And the question is, can somebody within the UCI family, can they help us more effectively and more rapidly locate that technology and then help us qualify it? And when I mean qualify it, what that means is, are their claims legitimate? Is it truly disruptive? Is it better than anything else out there? And, you know, I'm using layman's terms. I'm sure there's a PhD equivalent, but it's like, we got to know that this is powerful and compelling, and that we should enter into a relationship to pursue an acquisition. So they get to be involved from beginning to end, because they find the technology, they qualify it, they strategically position it, they're involved in the acquisition. Maybe they're a consultant to the company that we acquire. Maybe they join that company because they're so expert in that technology that they go with the technology into the acquisition, and they're a member of the management team. So, you know, yeah, we're looking for a whole package, but we're willing to create it over time. If you bring the technology expertise, we'll train you in finance, and vice versa.
So there's another question which I think is very relevant. There are some people who do cancer biology and neuroscience stuff, but then, you know, the more they're learning about this venture capitalist and business side and the technology which you guys acquire and you know, work on, that's different from the research and work they do. Do you think they will bring value to the whole process of identifying that technology, even if they don't have a technical background, but they have the method of analyzing the data, looking for things, you know, looking for that needle in the haystack? What do you think about that?
Yeah, that's the value. The value is your training and your skill set and your ability to apply what you've learned in field A to field Z, right? And ideally, to because of your background, to find opportunities where technology that was developed to address a problem in industry A is applied to industry Z. That's, by definition, that's disruptive. And that's another example of why this company would never find that technology. So if we start with the immediately deployable technology and we apply it in a field that it was never intended for, like boron nitride nanotubes in water filtration, right? That's not something that's done yet. But so, yeah, to answer your question, it's, you know, what you're learning while you're getting your PhD is equally or perhaps more valuable than the fact that your PhD is in cancer research.
Marcia has a question. I'm sorry, Marcia, your question sort of got lost. I will answer now. Yes. Marcia says she's still a little confused on ownership of technology and what would be the share of the person who developed that technology.
Well, so we're dealing with individuals who own and control the technology. They own the patent if there is one. And maybe they brought in some partners in the past. Maybe they even managed to raise a little bit of venture capital. Let's say they raised $1 million in, not in grants, but in you know, investment capital. So when they raise their $1 million, they will share ownership with whoever put the $1 million into the company. So maybe now they only own 70% of the technology. And as I said before, whoever owns this technology will get their pro rata share. If they raised money at a $3 million valuation and they've made progress since then, and it's deemed that it's worth $5 million now, the owners of that technology will get $5 million worth of stock in this company that we acquire. But again, that's not success. You know, buying a company isn't success. Selling a company for more than you paid for it, that's success, right? So when the technology and the people surrounding it come in for some amount of stock, that's a start. But the nice thing is you will no longer be trying to raise money $100,000 at a time so that you can continue your research. Now you're part of a $50 million company that has revenue and cash flow and customers and has all of these resources that you would have killed for in the past. And now you're working from within an organization, and you can be working on that technology 2.0. So, you know, did that answer the question?
Yeah, for sure. We have another question from Daniel, our own Daniel from TCP. Oftentimes people who want to license technology end up being great acquisition targets. I guess this was probably a comment, right, Daniel? Okay.
Yeah, you know, actually,
yes.
Surinder, Daniel, I'm glad you said that, because that's an important point. People say, how do we identify the acquisition targets? And in many cases, those acquisition targets might be a company that you would otherwise seek to license your technology to, right? Because it's that strategic fit of your technology and their product or their service that's going to drive the value. So what I was observing was these PhDs and engineers trying to convince some company of the potential of this technology. And you know what? The companies, in a lot of cases, they understood that. They knew there was great potential there, but they weren't interested in modifying the way they did business. So the model here is, rather than trying to push technology into the market, we're going to acquire infrastructure and commercialize the technology ourselves.
We have one last question by Andrew. Andrew just got off the call because he had another meeting, but he requested me to answer this question. He says, did you have to demonstrate efficacy to a regulatory body in that case? I guess it was probably relevant to some discussion you had. So when you, I believe when you acquire a technology, you're working on, like sort of rebranding, did you have to go through any regulatory body for that?
Right. And in some cases you do. And that's a sort of a negative on our checklist. And I'll just mention, on my LinkedIn profile, there are 3 documents. There's one document that explains this strategy and describes our team, which is very impressive, by the way. There's another document which we call our technology screen. And it's basically what I showed you before in this presentation, but in order, it'll show you, what's important. And in one of those cases, what's important to us is that it's turnkey and fully ready, meaning that it also does not require to go through some sort of certification process or EPA, technology readiness level or whatever. And so if it does, it's not necessarily a deal killer, but it makes it less appealing to us because it's going to add time to the process and probably cost.
Great. Well, I think we are done with the question answers. Again, saying if you have any more questions, please contact Michael on his LinkedIn profile. Write a short message saying that you attended this webinar, if you like, to compliment him, and ask him anything more if you want to ask, and then we can go from there. Second thing, I will be sharing the advertisement, UCI, the internship which Michael was talking about. I'll be sharing that shortly. And with that, Michael, thank you very much for coming and enlightening us about this whole space, which we don't really know about. I think a lot of good things came out of it, and I'm sure we have a better understanding and appreciation for the whole field of venture capitalism and private equity and commercial technology commercialization. And it's not just something people walking around with briefcase full of money. Thank you.
Well, I'm completely happy to do it. As I said, I would have preferred to do it in person, and one day we will.
Yeah.
But in the meantime, if there are questions or, I'm happy to talk to folks who are interested in what we're doing.
Yep. Great. Thank you.